Hello and welcome. In today's community call or video, shall I say, we're going to be discussing our 5 minute strategy. Not only are we going to be discussing and explaining what this strategy is, but also how we trade it. So the use of discretion, such as choosing what trades to take, when to trade, and when not to trade. So obviously, it's important to remember that trading isn't just about strategy, a mechanical system. It's also about an edge. And that's what we're going to run through so you can understand potentially how to get an idea to maybe apply some of the concepts or this strategy to your trading, but also maybe take from how we decipher when to and to not trade. So, without further ado, Edson, would you like to jump in and explain to me very simply, as if I've never heard before, what 5 minute strategy is, what we're looking for within the London Silver Bullet session?
So it pretty much sums itself up in the title, the 5 minute London Silver Bullet strategy. But essentially, what we're looking for is a fair value gap within the London Silver Bullet session, which is 8 to 9 a.m. And then in winter, it drops back to like 7 to 8, which is awful. But we're looking for a fair value gap within this Silver Bullet session. And not only that, we are wanting this out of some sort of kind of thanks, Okan. Discretionary position. So by this, I'm meaning like maybe a liquidity sweep off a POI, Asia high or low, and yeah, we add all of this up together in the silver bullet session with the 5 minute fair value gap to take a trade. So if we get a 5 minute bullish fair value gap and it's off an hourly BISI, then we'll take that, especially if it's like Asia low or something like that. Did you want to share some examples?
Yeah, you nailed it pretty well. So it's very simple, isn't it? We're just looking for a 5 minute fair value gap in essence. So yeah, I'm going to show some examples. I have a good example actually here, which I'm going to share my screen for you all. Yeah. Here we go. Okay, so I have two examples listed. So this is an example here, which has discretion used. I'm going to clean my chart for you. So this is the London Silver Bullet session here, 8 a.m., where my cursor is. I'll make it a bit bigger for you. And as you can see, on Discover it for you, I do trade the 1 minute as well, so we'll get rid of them as well. You can see here is our Silver Bullet session. So 3 to 4 a.m. New York session. And we got a bearish fair value gap. Now, despite this massive bull trend, because we had taken the New York session high with an SMT, we had reason to short into this hourly BISI. So on this occasion, because we did have potential for a reversal, we took this. Now, as you'll see, the trade is not dragged across for a reason. Now, as we mentioned before, there's the mechanical strategy. There's one thing which is the fair value gap. Then there's another thing which is the discretion and something that has come through many months of trading this now. We've come to understand that sometimes the 5 minute can give you a move, but as you can see, it can reverse. So simply, we always is the key word, put our stop loss on the third candle, high or low. So we enter on the fair value gap. As you can see here, this SIBI, make it more outlined for you. Going across, we put our stop loss on the third candle high. Now we target a 2R if in doubt. So if in doubt, 2R out. We say this a lot to everyone in our groups. If you're not sure of a target, which you do typically want to be for the majority of trades, 2R out. Now with a 5 minute, we can be a bit more lenient in terms of not having a draw, as it's more of just higher time frame sort of grab. We're looking to trade the volume, some bullet. So because we came down to the hourly, we'd displaced over 50% of our target. We then basically set break even. And as simple as that, the idea, like I said before, we're looking for a clear, expansive draw away from our entry. And because we got that, we set break even. Because if it's coming back, we could expect an SL. And as you can see here, on this day did in fact get saved from a loss by doing so. So originally when we first started trading the 5 minute, we didn't do this. We just traded set and completely forgot about it. And believe it or not, this actually worked. It was profitable, just taking every single trade. But we realized through time that there are a lot of trades which we almost could tell every time, could smell it a mile away. They were stop losses. And so that's when we introduced discretion, the likes of set and break even, and we've stopped doing that. So I believe I have another example, and that is here. Here. Okay. So again, you have to excuse the mess. This is another example of discretion. It's actually a very good, similar example to before. So we have the sell-off here. We have a 5 minute SIBI. Now, because of discretion, and like I said, we can tell when there are trades we are wanting to or not take. In this instance, we did not take this. Now, here, if you see my fib tool, I've drawn it as if I've taken the trade. So this entry here is where I would have entered. The stop loss here, third candle high. And in fact, this trade, if I had taken it, would have run perfectly to R, which is fine. You might see that's frustrating, but the principle actually is that that's a win because the discretion was not to take that as we didn't see ourselves getting a 2R. And as you can see, price ran, unfortunately, in this case, perfectly to 2R example and then reverse higher. So fine, you can look at that as a missed win. But the whole point is discretion told us, hey, this is extremely unlikely to give you a win. And we decided not to take it. So those two examples alone kind of just show you two good examples of when we're not taking them. And so that should kind of really explain it. We're looking to trade based on simple liquidity. You know, if Asia low here had just been taken, this place high, we'd be happy to take it. Got the conviction. So Edson, am I right in saying you have some examples, my friend?
Yeah, so
You got anything you'd like
I
to
think
add
you'll
as
have
well?
to stop. I think you'll have to stop your share, but I was going to dive a bit into the importance of Asia range because something every or people in the community were asking is first of all how we look for reversals, and second of all how we kind of spot bad price action. And Asia range is kind of the answer to both. So let me see if I think it will send you a request.
There you go. Teasing you.
There we go. I can now share that. Show meeting. There we go. Right. So can you see this screen?
Yeah.
So I've got a few examples marked out. Each blue line is a good example of when Asia range is in our favor, and each red line is an example of when it's not. So let's look at this first one. And in fact, on this first one, there is a trade taken. So what we're looking for from Asia range ideally is a tight consolidation. And the reason we're looking for this is because Asia range is the most traded session out of the whole 24 hours of trading. And this is where the most liquidity is built up. So, with this being tight and compact and having a high and a low that's not far from each other, we can expect quite easy reversals. So, if we're taking the low, we can expect it to quite easily, after liquidating them, go back up to the high and vice versa. And here's a perfect example of that. I say perfect, but it also adds something else that we mentioned before. I'll see if I can zoom in on here for you. Is that the right session? Yes. So I mentioned before we were also looking for confluences, and what we mean by this is um, technical analysis that stacks up. So the first one here is Asia low being taken, and so I've got this on the wrong chart, but trust me, on the S&P 500 here, where we haven't taken the low, on the Nasdaq we have taken the low. So this is our SMT here, as well as taking the Asia low. As we've taken that low, we can kind of expect a reversal because we've got our tight Asia range. So we've liquidated all the people that will have their kind of sell stops on here. We can expect a reversal upwards, and that's exactly what we got. As you can see, between the silver bullet window, we got our 5 minute fair value gap, entered straight on that, targeting the next draw on liquidity. And as Tom nicely explained, the 5 minute system, that's exactly what we're looking for. But the key part of this is the tight Asia range. So let's zoom out and see if we can have a look at one of those bad examples. So here, we have got anything but a tight Asia range. As soon as Asia opened, it expanded, and then for the rest of the session, it just held up here. There's not much liquidity to go off there, and we didn't take any positions. And it's probably a good thing we didn't. We wouldn't have got this sell at the end, and it wouldn't have given us anything anyway. But yeah, if we got a sell in here, we wouldn't have taken it because of all this kind of price below us. We've got a lot of like opposition. So we've got a lot of buy side kind of bias. So we don't want to be taking setups when we're in this kind of expansion. Move along to another one. So here's a good example. So we didn't take a trade on this one, but the point still applies. So we've got quite a tight Asia range. It's not the best, but it shows the likelihood of a reversal. So as we've got this consolidating Asia range, as soon as we've taken the low, it doesn't take us long to come straight back up and take the high. And this follows the usual system that we see throughout the day. London is what manipulates, or Asia is what accumulates, London's what manipulates, and New York is where we expand. This is a perfect example of it. Yes, Asia could have been slightly tighter and that would have been nicer, but beggars can't be choosers. We're traders at the end of the day. We're not making the market, so we have to take what we're given. I think I've got another example somewhere. Okay, on to gold now, I think. Yeah, there's my first one, there's my second. So gold currently is a great example for bad Asia ranges, as Tom knows kind of all too well. So going back to that point of we want a tight Asia range to see a reversal, here we've got anything but a tight Asia range, the opposite of what I showed you two examples ago. We just dropped off. And what this is telling us is that we're probably not going to reverse today because price is so bearish. And as you can see, for the rest of the day, it just drops off. Yes, we do reverse, but we only properly reverse after two slightly tighter Asia ranges. Again, not perfect, but as you can see, we had this one after we took the low of it kind of later on in the day. In the PM session, we then reversed on upwards. And we reversed on upwards to another example of a bad Asia range, which gold is kind of, yeah, it's on one at the moment. So as you can see, middle of the Asia range, we just expanded. This isn't much of a range. We kind of want it to be half the size and a bit more choppier. And this, once again, so far, is adding to the point of not causing a reversal. Throughout the day in New York, we took the high and it didn't mean anything. Yes, we got a slight reaction because there have been people up here selling, so it would have pushed it slightly down, but we just continued on upwards. And we probably will do the same tomorrow, and then it might come down eventually. Who knows? But the point you should be getting out of this is that Asia range is what allows us to kind of call bad price action as well as when we're looking for our reversals. So if we've got a highly expansive Asia range, we'll be looking to kind of only take very specific setups if they form. But other than that, staying out. Whereas if we've got a tight consolidating Asia range, we'll be looking to take our trades kind of in correspondence to that. So if we take the low, we'll be looking to take buys. If we take the high, we'll be looking to take sells. So I think that would probably be our key indicator as to bad price action. I don't really know another way to tell off the top of my head.
Yeah, I'd say how it aligns with high time frame price action as well. So high time frame point of interest. So are we talking hourly fair value gaps, daily fair value gaps? Have we swept any session highs or lows, or are we just kind of bobbing around above or below them? Even there's so much to go into even the 1 minute or like we just said, more on the 5 minute and look at what's being respected in an age range. So yes, we're obviously looking for accumulation or expansion and so on, but we're also looking just for good price action. It's as simple as that. If we're seeing that fair value gaps are being disrespected, but price still then ends up going the opposite way, kind of indicates to us that price isn't being normal. We want price to clear. We want to have a draw. So at the end of the day, if we have a draw on liquidity, but price action isn't aligning to that, then we know the probabilities of us being able to get a high probability move, high probability trade. So align with that, it's going to be much harder. So another confluence as well, which we use for our 5 minute strategy, is in fact I trade the 1 minute on the Nasdaq, and one of the models I use for the 1 minute is based off a 5 minute BSC or CB, 5 minute fair value gap. So kind of comes in quite handy a lot of the time. Um, if my lower time frame draw or wherever I'm looking to trade the 1 minute to also doesn't align with the 5 minute, gives me another set of confluence to see whether this 5 minute is to be framed or not. Because if I'm already in a sell for a 1 minute trade, let's just say, and I can see that it's giving me a very small 5 minute buy, I can kind of tell that that's just fake out. If that makes sense. That setup is not one I should take. So at the end of the day, it's all about obviously starting on a high time frame, working my way down, and having it all aligned like perfect, which is jigsaw puzzle. So yeah, I think it's just the 5 minutes. Just the way we trade is it's like any strategy really. And we've been London traders for our entire time of trading. We, as I showed you, gold trades GU, and we trade the Asia strategy. We look for a sweep at a higher low and look to trade based off that. And what we've come to realize in over a year of live trading that is that when you have a sweep of the higher low, when Asia accumulates, that's when you've got the highest probability of London expanding. You're actually able to capitalize on point of the silver bullet. It's called a bullet for a reason. Okay, it's not called I don't know, floppy flamingo. As I showed you in some of those examples, price action went completely sideways. And if you'd also seen, Asia was expansive and then went sideways after. So you can kind of predict going into those days that price action was not going to be great. Whereas the first example it showed, it was kind of tight packed. And you could see there was going to be stops, price went up, could expect those stops to be taken before we got a higher move. And obviously that's how it played out perfectly. So the strategy is simple as a principle, 5 minute fair value gap. Third, third candle lower high stop loss, but we're looking for a draw on liquidity to target, ideally, but also a reason for price to be moving that way. Because obviously price moves for one of a few reasons, and we're not just gambling at the end of the day, we're not just trying to throw our money at the markets because there's a fair value gap. So that should be quite clear on how we trade the 5 minute. Do you think there's anything we could add to that?
Yeah, I was just gonna kind of address that point again. I think it's quite a common thing, especially, well, I wouldn't even say just for new traders, but for traders in general who maybe don't have um, kind of a lot of screen time, is to want to be able to call bad price action. Because at the end of the day, we'd all love to be able to call bad PA. If I knew at the start of every silver bullet session, and if Tom knew at the start of every silver bullet session that it was going to be a stinker, then win rate would be through the roof, but it's not because none of us know what's coming. Sometimes you can have an expansive Asia session and then you can have a really nice day in the silver bullet. Like it can just move properly. It can happen. And you can have a really consolidated Asia session and then London might just decide to do the same and you can't get in anything and it's not brilliant. So what I'm trying to say is that you'll never be able to call bad price action 100%. Like we've mentioned, there are indicators like Asia range is a pretty solid indicator going from high time frame all the way down to the time frame you're trading on. Um, these can all be things you can use as an indicator, but you'll never know. So don't get bogged down in trying to call bad price action. The only way you'll get better at knowing when it's coming is market experience. We only know this because, well, we've done a lot of back testing and we've spent, like Tom said, over a year trading Forex live. So, and because our strategy is off Asia, we know Asia session quite well. So that's why we're telling you guys this. Other than that, there isn't much you can do. So don't get bogged down in trying to predict it every time.
Yeah, the main thing you can do always comes after the fact. So before the fact, you can have a hint, you can have a guess, a gamble, or maybe that price might be terrible in this session. You'll never truly know until you get your A-star setup, which you enter, like we actually had on Monday. We had the most perfect inversion, sold off, tap to Bissy, full on clean, perfect setup with an SMT. Enter the entire session sideways. You learn from these things and you see, right, if I've entered a trade and an hour later, price action's gone sideways, bad price action, you've lost that initial volatility which you entered based off, let's say. So when you get bad price action, when you have these phases, when these things come around, the only thing you can do is adapt. Like the example I showed you, you can set break even. So if price action's not gonna be as volatile as you'd like for the trade, then you can set break even. But again, like the one I showed you, or you can reduce risk. If you can kind of sense on the day, maybe you still want to take the trade because it's completely valid, you can use slightly lower risk. But personally, Your risk, I think, should stay the same. It's a case of just simply closing or setting break even. Because if you're considering lowering your risks, then you probably shouldn't take it in the first place. So the likes of break even or getting out of position, they're your best ways to handle bad price action when you've clearly established it is a by PA by barcoding your entry. It's the best way to do it. So yeah, so a lot of it comes with experience, like I said. So,
Yeah.
but
And
gotta
a
apply
lot of it
logic.
comes from the right experience. Like, don't just stare at the markets and call it experience, and then hope at the end of the year you understand Asia range and you understand how to read bad price action. Do the right things. Do your back testing. Do your journaling. Learn from Asia range. If you say the next time you enter one of your sessions and it's bad price action, look at what happened before and take notes of it. If Asia was expansive, if it consolidated, if you're in a high time frame level, if you're not, if you're just in the middle of nowhere, you could be at all-time highs. It might be a bank holiday for all you know. Make sure you journal it because this is the only way that you'll learn. Um, you'll find the more and more you journal, at the end of it, the less and less you need to journal because the same things keep happening, and that's why trading works. It's because the same things keep happening. So make notes of why um, you think the bad price action has happened. If you're in the group, send a message in and be like, "Is this why it happened?" And we'll be like, "Yes" or "No," and we'll try and give you some advice. Uh, if not, and you're just watching it, still do the same. Um, and if you've got someone who you look up to or is your mentor or something like that, or if you're in a group, ask them, see what other things they might spot that you haven't. Because all these different perspectives, if you can get more and more eyeballs on what you're thinking, then you can get more and more perspectives and answers. And like I said, there might be something you missed.
Yeah, even the likes of high impact news later on the day. I mean, at this point,
Yeah,
Donald Trump might be ready to type up a tweet when he wakes up. Who knows? These things can affect the market as much as obviously seeing age range expand or not expand and so on. So you just got to consider all things in mind. So let's say you were trading the New York AM session, you're going to be trading more likely around high impact news. So let's say the news is after the silver bullet or before, or maybe there's news before and after. You can expect price action to potentially be rubbish. You can expect high volatility, but then also uncertainty because there's a following news event. So you've got to consider all factors, the literal price action on your screen, but then also the real world factors, bank holiday, news, and so on. So yeah, I think that's we've done a pretty good job there. I think everyone should understand what 5 minute is, how we trade it, and then how to spot and manage bad price action. I think we've done a good job. What do you
yeah, I
think?
think so. I'll double check that that's everything.
Yeah, I think
But
so.
yeah, like you say, I think we have mentioned everything that people were saying. So as a community call. Um, so yeah, well, Okan's first comment: winning isn't always about take profits. It's about avoiding situations, setting break even, or analyzing when you should or shouldn't enter. And that is pretty much exactly what we've covered. And
Yeah.
it's a good note to finish on. I think that you should probably remember, or not probably, you should definitely remember winning isn't just about take profits. A lot of the time, when me and Tom hit the gym after a 5 minute session where we've avoided an L, we'll often talk about how it feels better because, well, it's the same thing. Avoiding an L is the same thing as hitting a TP. Say if you avoid two L's, that's the same as hitting a 2R because you have made that much profit or you've maintained that much profit. So, and same for making decisions like setting break even and cutting your trade short if you see it reversing. Um, the one
Literally like those two examples I
thing
gave.
Yeah, the one thing that you've always got to keep in mind is to not overdo it. And the only way you can learn that is your back testing. But yeah, you can't overdo these things. If you're constantly getting out of trades just because you get a bit emotional about it, then you've got problems. But if you're getting out of trades because of logical reasons, because price is showing that it's going to hit your stop loss or something like that, then you're getting out for the right reasons. If you're getting out because you just don't feel like it, then that's wrong, and you need to do more looking into your data. But other than that, I think
Just
that's
simple way of
everything
putting it
covered.
is you want to be in it for
Yeah,
the right reasons, and then you also want to be getting out of it for the right reasons. And if that's not your TP or
yeah,
SL, got to be lordship. So pretty simple, really. Feel like that.
spot on.
Cool. All right. Well, thank you everyone for joining us. We hope you found some value, and if you did, let us know in the comments and so on, and give us some feedback if there's things you want us to cover. Maybe you want us to go more in depth on the 1 minute. Obviously, the 1 minute's a lot more complex, or even run through our gold or GU strategies. Maybe explain age range, how we view it more. Let us know. But without further ado, thank you for joining. I hope you all enjoyed. Peace out.